Give us your thoughts then ahead of Jackson Hole over what we should expect from Janet Yellen, because it seems there is an expectation she might give us clues. That seems to be what you hear from some investors. And yet I spoke to Megan Green from Manulife in the last hour, and she was saying we shouldn't expect too much. It's only, as Mike McKee was there saying, it's only on a few occasions that we've had clues as to the very near-term direction of interest rate policy.
So I think the issue of the September versus November debate should be put to rest. We shouldn't expect those smoke signals from Wyoming to tell us very much about that. And that's only right, because the whole emphasis of the Wyoming gathering is to discuss the framework of monetary policy in a very difficult economic environment. So it is really about whether forward guidance works, what the neutral so-called equilibrium interest rate is, and just the way the Fed communicates with the markets, which of course has been a real sore point, because that has really exposed the Fed's communication aspects very, very clearly in terms of being quite inadequate in the last few years.
So it is a very academic event. The title of the event this time is Designing Resilient Monetary Policy Frameworks for the Future. So no doubt we'll hear a lot of the academic thought around that. But in terms of the market's positioning heading into this, and you say we shouldn't look for smoke signals around, you know, September versus November, for example. I've got a chart here, though, that shows how Fed hawks, the commentary we've heard from Fed hawks over the last 2 weeks has been lifting short-end rates in the United States. So although the work function shows only a 54% chance now of a rate hike by the end of this year, which, yes, is more than 50, but it's still only 54% by the end of this year, it does seem that increasingly the short end of the yield curve is positioning for a hike. If we get something dovish from Janet Yellen, then do we risk some market volatility?
I think we do, to the extent that that the market is pricing itself a possibly one rate hike. But you know what the real problem is? The real problem is that the market is not priced for rate hikes in the way that the Fed would have anticipated over the next few years, and indeed further out, because the Fed keeps telling us that the long-term interest rate is, well, more recently it's told us it's about 3%. The market is defying that and saying, well, if we're lucky, we get to 2 further out of the on the curve. And that's where the real debate is. For me, the key question is whether we achieve liftoff at all. You know, we managed to achieve one interest rate rise, and then
was that not liftoff?
No.
What do we call that?
No, that's a kind of stalling, really. I mean, you know,
it's just on the runway.
15 months ago, you know, the Fed was telling us that there'd be 4 or 5 rate hikes to come over an 18-month period, and here we're talking about whether we achieve one. It's like watching a bad soap, a series of episodes where you know how it's going to end, and you know that the market will win and the Fed will lose.
And does the answer lie with those who are assembled or going to assemble at Jackson Hole? Because this is going to be a symposium about monetary policy, rightly, that's what it's all about. And yet what we might hear, and what we have been hearing from central bank players globally, is, come on, governments, fiscal actors, you need to step up.
Well, that's an interesting question, because, of course, if you look at both sides of the presidential election divide, both sides are promising a step up in infrastructure spending, fiscal stimulus. And one of the most difficult considerations at the moment is whether that's going to come or not, because we know that there are issues with whether Congress will approve it. I think everybody, bar the legislators, agree that the U.S. should be spending more on infrastructure. But will the legislators play ball, or will it be difficult to get it? Because, of course, if we do get that infra spending, monetary policy doesn't have to work so hard in keeping the economic show on the road, and they can actually then progress on the rate normalization path a little bit more quickly, but of course that's a big question.
And if the big challenge is then more fiscal spending and structural reform, perhaps in Europe, perhaps in Japan, globally, what can those assembled at Jackson Hole really do that will make a material difference? I talked to Megan Green in the last hour about how there might be conversations about changing inflation targets, setting different types of targets around nominal GDP, for example. Does any of that matter to you as an investor, Tapan?
Oh, totally. And the issue, rather than thinking about September versus November, the big debate is really what happens to that interest rate over the next 5 years, and the way that forward guidance has signally failed in the markets. Now, that's not something the Fed's going to own up to say our communication strategy has failed, but behind the scenes there will be a huge amount of debate on whether that systematic misleading of message passing to the markets, how much damage it's doing in putting the Fed now in a very difficult place, because if they do try and normalize rates, they risk another bond market shock, because the bond market's not priced for that. But yet if they
despite
don't...
what we talked about the 2-year...
Exactly. And yet, as you say, if they don't raise rates now over the next few months, then the bond market will say, well, 0 to infinity. That's what we should expect of the Fed, which would be counterproductive. So one way or the other, that challenge is very large indeed.